Well, good morning, all. I'm Tom Shannon. I'm the founder and CEO of Bowlero Corporation. We're the world's largest owner-operator of bowling alleys in the world. And we've been doing this for 25 years. We went public in December through a de-SPAC. The company really started back in 1997. I was living in New York City. I got invited to a party at the original Bowlmor Lanes down in Greenwich Village. Maybe some of you went there. It's kind of an iconic place, and it was very typical of bowling alleys at the time, run down, underinvested in, and I saw that it had this potential to be more than sort of this downscale, crappy activity. And so I acquired it, I renovated it, and I took revenue in that one location from $1 million a year to $15 million, and it changed the paradigm of bowling. So what people don't understand is bowling is actually an incredibly good, growing business and very profitable. The reason for that is there's no cost of goods sold on 2/3 of our revenue, right? Bowling and shoes have no cost of goods sold. And so we end up with very high margins and very high returns. Really the transitional point in the company's history was we had grown through building and buying a couple of centers. We were about 6 locations, and in 2013 we reverse merged into AMF along with our partner at the time, Cerberus. We took AMF out of bankruptcy. And overnight, we went from 6 bowling centers to 272, largest in the world. We took $30 million of cost out of AMF in the first year, and we started growing revenue. And we got Ebitda performance doubled in AMF from 60 million pre-acquisition to about 120 million in 2 years. In short order, in 2014, we acquired 85 bowling centers from Brunswick Corporation. They were the number 2 player in the world, so we'd acquired number 1 and number 2 in the world. And then we changed the name of the company to Bowlero to reflect our growth brand, which is Bowlero, which if you think about in the sort of the hotel paradigm, Bowlero is like the W of hotels. It's sort of hip, cool, great design, focused on millennials, et cetera. We acquired the PBA in 2019, the Professional Bowlers Association. So we produce about 70 hours of original TV content every year. That with re-airs is about 1,000 hours, which basically serves us as an infomercial for bowling. And then, as I mentioned, we went public in December of last year. So we are the largest bowling center owner-operator in the world by about 7x over number 2. And yet we only have about 8% market share in the US and probably 2% globally. And this is important because if you look all the way on the right, there are about 3,500 independently owned and operated U.S. bowling centers, most of whom are owned by elderly proprietors who are looking to transition out of ownership. And so it's an incredible opportunity for us to continue our consolidation of the industry. We've bought a number of these independent centers and we'll continue to do so over time. Between the acquisition opportunities and the new build opportunities, I think that realistically we could end up with between 700 and 800 bowling centers in the U.S., up from about 322 currently. So we're pretty concentrated in the growth markets on the coasts. Our largest market is California. We have about 50 locations there. But the market opportunity in California is so large that number could probably be double or possibly even triple. You can see we play heavily in New York, New Jersey, the Carolinas, Virginia, about 25 in Florida and growing rapidly, about 25 in Texas and growing, about 20 in Arizona, mostly in Phoenix, and then some other concentrations. But what you see on this map is a lot of white space. So there are a lot of places that we aren't. So bowling remains a very popular bedrock American activity. A lot of people don't think about it, but one thing to remember, about 70 million Americans bowl every year, compared to about 24 million who golf and probably fewer than 7 million who ski. So bowling tends to fly under the radar on Wall Street, but it's a really large, vibrant business in the United States. Pre-COVID, we were doing pretty robust same-store sales growth, 4.9% average over those 4 years. Growth has accelerated dramatically coming out of COVID for a lot of reasons. One is pent-up demand. Another is we've been able to take a lot of pricing in this inflationary environment. And we actually benefit in this environment from inflation because, as I mentioned before, 2/3 of our revenue has no COGS. So we're not really subject to a lot of input cost inflation, and yet we're able to take, pricing like everyone else. And so we're actually seeing margin expansion in this environment. So all of this translates into really, really high returns. A couple of metrics I want you to remember. I think this is maybe one of the key ones. The industry average Ebitda margin in bowling is 20%. Ours is about 54%. Most of that is a difference in how we operate. We're more efficient at labor allocation. We're more efficient and much more advanced in things like event booking and the whole menu that we offer, food and beverage offerings, all these other things. So not only do we drive much more top line, much more efficient in how we, produce the offering. And so when you go from 20% to 54%, what that means is when you're buying centers, right, typically mom and pop centers, you're getting more than a doubling of margin in very short order with minimal CapEx. And so that cuts your purchase price multiple in half. So this is the most recent cohort, but it tells a broader picture story. 26 centers acquired or built. Of the ones that were acquired, we paid about 7.3 times EBITDA on a TTM basis, but on a forward basis, that was 3.5 times because of the margin expansion. And this results in an unlevered ROI of 36%. And we've seen a high 30% ROI over hundreds of millions of dollars invested in acquisitions, renovations, and new builds since we acquired AMF in 2013. So this isn't a fluke. We get consistently high 30% unlevered ROIs by investing in this business. It's a phenomenal business. We bought the PBA in 2019, and this serves as really a wonderful global infomercial for bowling. What's interesting about this is that it makes about $1 million of EBITDA for us, but it enabled us to reduce our marketing spend by about $10 million. So we paid $11 million, we get $1 million of EBITDA out of it, and we're saving $10 million a year. With re-airs, as I mentioned, about 1,000 hours of viewership on Fox and CBS. And in 2020, we actually increased our viewership to 23 million people. We're moving into the gambling space. So we have something called Rumble, which is a global tournament where we're able to link all the participating centers. And the last Rumble we did, we had about 20,000 participants who are competing for a $50,000 grand prize. And this serves as the test bed for the technology to have gambling in center. And I think this is the next sort of step function higher in terms of where this business can go. So imagine this. You step up to the line and it says, welcome back. The kiosk says, welcome back. Your odds on getting a strike on this ball are X. Would you like to wager $1, $5, $10, $20? And you wager $5 and you get 9 pins down. It says, oh, too bad. You didn't get the strike, but here are your odds on picking up the spare, right? And in this sort of short cycle time, instant gratification society, it becomes an incredibly compelling proposition. I know I feel it, and everyone I talk to who thinks about this is like, yeah, that would be a much more exciting element. I think that this has the potential to increase revenue 20%, which would be about a 50% increase in EBITDA. We hope to have this in beta form in the centers around September of this year. We also developed a methodology which we call QMS, Quantitative Management Solutions, which is really the underpinning of what enables us to get from that 20% industry average EBITDA margin to our 54%. I won't go into too much detail, but it's an AI tool that we've been developing really for the last 8 years. It's served us incredibly well, and it may have commercial opportunities beyond us eventually. So the company has been profitable from the start. Quite profitable. Pre-COVID, revenues on a run rate were about $750 million with about $200 million of profit. We've seen a considerable expansion in revenue and profit growth coming out of COVID. which we'll get to in a minute. But we've guided very conservatively in our first quarter, and we are on a June 30 fiscal, so we're 6 months offset from calendar. So Q1 was July, August, September. We did, Q2, which was October, November, December, we did about $67 million of EBITDA, which was a $70 million improvement for the same time the year previously, and far in excess of what our projections were. So we've projected very conservatively. In fact, here is that specific performance. EBITDA in the second quarter was $66.8 million. And one thing that's important to keep in mind is that included December, which is our busiest event month of the year, that was significantly impacted by Omicron. So we had been trending up about 10% in terms of event sales versus the previous year. And I expected that going into December, we'd be up about 15%. Omicron hit on Black Friday. Everyone canceled their events, and we ended up being down 25%. So we did about $67 million of EBITDA in the quarter. That number really would have been about 80 had Omicron not hit. So huge resurgence coming out of COVID. And our 52-week adjusted EBITDA through that quarter, $195 million. Q2 is a good quarter for us. Call it $80 million, right, on a normalized basis. The quarter that finished recently, January, February, March, historically is a better EBITDA quarter for us than Q2. So reasonable to assume that our performance in the last quarter was better, meaningfully better than our performance in this quarter, just based on history. So as good as our performance has been, this slide tells a very interesting story, which is that if you look at the top line, the darker line, that is same-store sales excluding events. And the lower line is same-store sales including events. What's the difference? Mostly New York. Until very recently, the New York event market was basically shut down due to COVID restrictions, people not going back to the office, pressure on companies not to have events. That has now completely abated, and we're seeing an incredibly strong resurgence of the corporate event market. And so our performance, as strong as it's been over the last year, was adversely impacted by that, and now that cycle has reversed. So looking back at Q2, the quarter that ended at the end of December, you can see that versus pre-pandemic, EBITDA went from 53 to 67 million, up 26%, but probably even more interesting, our adjusted EBITDA margin expanded from 28.6 to 32.5. A couple things are going on. One is we re-engineered the business during COVID and took out a lot of cost, like a lot of companies, but we found a lot of efficiency gains. And we're also benefiting from these price increases that I mentioned before. Inflation is our friend in this business because no cost of goods sold for a game of bowling or shoe rental, which is 2/3 of our business. So we pass along price increases and we don't have those input costs. Our 52-week adjusted EBITDA is now at a higher level than it was pre-COVID, up to 195. You can see how it's sprung up. As I mentioned, historically, this last quarter that just ended is better than the quarter Q2 that we reported. So I think it's reasonable to assume that this trend line will continue. And then this really just talks about breakdown in revenue by category, and you can see that the laggard here was in group events. The walk-in retail business versus pre-pandemic was up meaningfully from 109 million to 137 million in the quarter. Leagues were actually flat, but group events had lagged. And so that headwind is now becoming a tailwind where we're seeing significant year-over-year increases in the event business. And so I think it bodes very well for the rest of this year and going forward. company produces a lot of cash, and we're sitting on a pretty decent cash balance. At the end of Q2, $115 million of cash, as I mentioned, historically, the quarter that just ended produces more cash than that, so you can assume that the cash balance is higher now than it was then. And that is the end of my prepared remarks. Happy to take any questions. In the back, sir.
Are you funding your acquisitions through cash flow or going on into?
Cash flow. Yeah.
What do most of the bowling alleys that you're acquiring look like? Are they, are there a lot of the old school ones where like you're trying to store it by hand, or have most of them been modernized?
Well, there are no more where they're scoring by hand. Although the first one I bought, Bowlmor in New York City, it was scoring by hand when I bought it, but that doesn't exist anymore. They vary widely from ones that are really run down to ones that are quite nice, and we price them accordingly. We've been very pleasantly surprised. I've got an excellent deal scout who's out calling proprietors, and we found a lot of centers in places you wouldn't expect that are doing really large numbers. And so, we've been really pleasantly surprised by the quality of centers out there. And the more centers that we acquire and look at, the larger we realize that the market potential is for us. Yes?
How many are you planning to either open, build, or acquire in 2022 and 2023?
So there's a little bit of lumpiness. Right now we have the largest pipeline we've ever had. The pace of the closing is really driven by the proprietors. In many cases, they've never sold a business before. They're elderly. So there's some lumpiness. In the last 6 months of calendar 21, I think we closed 22 acquisitions. I would say in the back half of this year, it's entirely possible that number is 15 or 20, but I would expect between new builds and acquisitions in 23, that number could be closer to 40.
Is that something that you would eventually roll out to all the centers, or just like a particular brand, like a Bowlero brand, or the certain centers are kind of more updated already? Is that something that will kind of eventually go everywhere?
Well, yeah, we anticipate it going everywhere because if the nicer centers have a retail crowd, but the more traditional centers have more of a sport crowd, right? Leagues and stuff like that. And so, millennials or people in our age, not that we're the same age, but, generally, right, they'll find this interesting recreationally. The league bowlers will find it interesting because they can compete. And we've got like 300 million sets of gameplay, so actuarially we know what the odds are, right? And the idea isn't necessarily that you would make money on the actual gambling transaction. I think it's that you would increase duration and you'd increase frequency. Now, it's entirely possible we make money on it, but the average person bowls like 1.25 times a year, right, who's a bowler. And so if you can increase that to 1.5 times or 1.75 times, right, it's a game changer in terms of revenue for us. And again, very high margin revenue. Or, the average person plays 2.2 games per visit. And if you can extend that to 2.4 or 2.5, again, it's hugely incremental in terms of profitability. So part of it is the stickiness. Part of it is increased repetition of visit. But then it's entirely possible we make money on the gambling part, or we could take the technology and enable other non-competing centers to utilize it, and we could get a fee on that or hold, right? So, and then of course internationally, where we really have no centers, and we have a couple in Canada, a couple in Mexico. There's a huge global market for bowling that we don't currently play in, and you could license this technology to the rest of the world. So there's a lot of potential upside, but we really view it as something to get people to stay longer and come back more. Mm-hmm. Absolutely. Yeah, but we've been having them for 4 years. This is not a new phenomena. I will say that it was really bad 6 months ago, and it's less bad now. People aren't quitting as much as they were. We're finding more quality talent coming into the labor force than we did before. But this is not a new phenomena for us. One of the beauties of our business is it's very, very labor efficient. So you think about bowling, it's a self-serve model. You come in, I give you a pair of shoes, I turn on your lane, and then I see you 2 hours later. Now, on the food and beverage side, there's a little bit more labor intensity, but not a lot. I mean, I'd like to have a server come to your lane and ask you if you'd like to eat or drink, but if I don't have that server, you'll go to the bar and order, right? So there isn't a very high service expectation in a bowling center, which is great. Again, probably 75% of the revenue, which would be bowling, shoes, and arcade, use very, very little labor. So you can run a large, high-volume bowling alley with surprisingly little labor. So it's a tough environment for everyone. It's a little bit less tough for us. I guess the last point on that is these aren't specialized positions. There's really only about 2 specialized positions in a bowling alley. One is the cook, and again, the menus aren't very ambitious, so you don't need a real cook. And the other is the mechanic in the back, but we have a solution for that, which is what are called string machines, where the pins actually are reset using strings, and they score about the same as the regular mechanical pin setter, but they don't require a mechanic. And so we've replaced the traditional machines with string machines in some of our highest labor cost centers, particularly in Manhattan. We anticipate in some of these centers saving $250,000 a year per center, which is about a 25 or 30% ROI on the cost of the installation. So we're solving kind of the most critical labor shortage issue with technology. I don't think that's going to work. But look, we have the benefit of scale. So we have about 10,000 associates. We have 8 regional vice presidents. We have about 70 district managers. And so we have the infrastructure to be able to hire and retain. And coming out of COVID, we would get notification that we could reopen with about a day's notice in most places. And so from a standing start, our guys had kept contact with enough staff that we were able to reopen in a day when we have competitors who still aren't running a full schedule in many markets. So we have some benefits of scale. The other thing quickly on this is we're using kiosks to order food and beverage in our highest volume centers. So it relieves the need for a server. You can order right there. Yeah. There was a question over here. Yes. About 80%. So we're sitting on about 40 owned pieces of land, and that number is growing. We could probably flip that in a sale leaseback at a 6 cap or better, which is what, about a 17x multiple. So there's probably, $30+ million of rent right now, which is being valued on a multiple of Ebitda basis that we could spin off at a 17 cap, which is just sort of more embedded value in the company that isn't, I think, reflected anywhere.
PBA is a membership-driven association. How does that fit into a corporate model? How do you own a membership-driven association that
Well, I don't know. I mean, it's more like the NFL than a nonprofit. You know, it's a for-profit business. There are benefits to being a member. The membership base is not big, but it is growing. But really, the PBA is really a media property.
Do you have any long-term plans for franchises or?
No, I don't think so for two reasons. One is we'd rather own the opportunities, and the other thing is these are pretty capital intensive, so it's not like opening a Subway. I mean, it's a big bet, and we're best suited to doing that.
What do you typically have to spend in taking over a mom-and-pop shop? I mean, obviously it varies all on the map in terms of how advanced the technology is and how similar it is to what you look like you typically, right?
Yeah, it really does vary widely. You know, I would say at the low end, it's $500,000, and part of that is putting our technology in, our point of sale system, our security system, our cameras, et cetera, and it can become much more expansive. Like we bought Bowl America, which we paid $44 million for 17 locations, 16 of which came with the real estate, mostly in Northern Virginia. And we've been selling off a lot of the real estate and for prices far in excess of what we thought. And we'll end up probably retaining about 5 of those locations at a zero cost basis. But one of the reasons that we got such a good deal on it is those had been pretty capital starved for a long time. And so there's a lot of reinvestment that they needed, which wasn't typical, but there was other value in terms of land value and also much greater operating potential of the centers that we kept. Anyway, I'm being told we're out of time. I really appreciate your attention and your questions. Thank you very much.